Thanks for the time. And today we're going to talk about Hon Hai's investment in Sharp. And the presentation will be divided into 5 parts. The first part, we will have a quick look on the company's profile related to this investment. And before the investment, we will analyze the initial condition leading up to the investment. And the third section, the volatile investment, focuses on the challenges and fluctuation during the investment period. And the fourth part is which is from 2016 to 2024, we discuss after the investment, evaluate the outcomes and progress. And finally, we'll have to conclude with the team's reflection on the case.
Okay. Sharp Corporation, operating within the consumer electronics industry, might face various threats, including losing market dominance over time if it does not continue to invest in its core business areas. Historically, as a major player in the global LCD market, Sharp has constantly pursued growth opportunities without compromise. Next, Foxconn, formerly known as Hon Hai, primarily operates in the electronics manufacturing services industry. It stands as the world's largest contract electronics manufacturer, producing devices for major companies such as Apple, Amazon, Sony, and Microsoft. Hon Hai also engages in assembly operations and provides contract manufacturing services across different categories of electronic devices. Next, please. SDP Company, or Sharp Display Products, specializes in producing large LCD panels and operates one of the largest and most sophisticated 10th generation LCD plants in the world. This facility is crucial for manufacturing large mother glass substrates for LCDs, essential for maintaining competitiveness in the display market for both Sharp and Hon Hai. SDP supports the creation of high-quality displays used in consumer electronics, thereby enhancing the presence of Sharp Corporation and Hon Hai in the digital display industry. Next. Hon Hai's acquisition of Sharp latest from 2012 to 2016. In 2012, Terry Gou successfully completed his investment in SDP, but due to rapidly declining Sharp's stock price, Hon Hai did not complete its acquisition of Sharp in 2012. Finally, Hon Hai acquires 66% of Sharp's equity. In August 2024, SDP announced its complete discontinuation and transformation into an AI-supported factory in the future. Okay, thanks. Next.
In our case study, we first analyzed Sharp's investment in SDP during 2007 to 2012 and why Hon Hai stepped in 2012. Let's take a close look at the story behind the SDP and G10 factory investment. Statistically, G10 plan presented nearly negative $4 billion NPV as well as a negative 0.049% IRR, which indicated that this project shouldn't be invested. By using 8% of discount rate and the 23.4% of tax rate in its 20-year lifespan, G10 plan started to show positive and slow increasing cash flow from asset from 2013. Therefore, it is evident that this project has high capital expenditure while the market needs are not fully exploited, and the customer base can support the business. Also, the overall market needs and the pricing structure won't be able to meet the expectations. Eventually, it needs to overcapacity and a low capacity utilization rate. Here's the detailed spreadsheet of how we calculate the NPV and IRR based on these assumptions. We just did 4 variables in the assumption to test the sensitivity, taking inflation into account. If we assume the product price drop rate decreased by 2% from 2011 to 2019 and 1% for the rest of 9 years, then it turns positive. This shows that the price is sensitive variable and can significantly impact the profitability. Cost is also a relative sensitive variable. By reducing 3% each year, while other variables stays unchanged, the NPV becomes positive. However, the change of discount rate didn't bring a big impact on NPV. In extreme case, when discount rate replaced to 1%, the NPV is still negative. For capacity sensitivity, even if the yield reaches to 100%, in other words, G10 plan was able to ramp up to full capacity from the beginning, it still can produce a positive NPV. Although the numbers didn't support the project, let's look into why Shop still invested 3.4 billion USD in SDP and G10. The reason can be first, the Shop firmly believed in the large-sized TV market. Secondly, the factory line could explore technology breakthroughs and maintain its leading place. Lastly, the unit cost could also be reduced by mass production. However, the external environment wasn't developing as they expected. There were three major obstacles: changing market demand, changing market competition, and the sales decline in the Chinese market, which caught Shop off guard. Shop's financial performance was marked by a pronounced decline in revenue and profitability, attributed to a sluggish response to cost reduction and heightened operational risks due to intense competition in technology and sales with its rivals. The company's aggressive investment in the volatile LCD market further worsened these issues. This led to a weakening internal cash flow and insufficient liquidity, as evidenced by the financial data. Shop has a reduced cash reserve and struggled to meet both short-term and long-term financial obligations. Moreover, the company increased its leverage to finance and the investment and cover operational expenses, which heightened the risk of debt crisis and potential bankruptcy. Its EBITDA was barely sufficient to cover its liabilities, and its EBIT was inadequate to service its interest expenses. The ROE fell to negative 60.09%, indicating not only a failure to generate returns to investors, but also a significant loss for stakeholders' equity. From the data analysis, we could know that the high cost in industry expansion and the low capacity utilization rates led to negative business performance during this time period and caused a sharp into financial crisis, credit downgrade, and a loss in the market share. Now let's move to why Hon Hai decided to invest in Shop. Historically, Hon Hai has a very successful acquisition of Shumei. For Terry goal is to enhance his political influence through a stronger global presence, also aim to craft a solid leadership image. From a company perspective, Terry's decision-making aligns resources with strategic goals, utilizing a structured equity framework to diversify investments and reduce risks. Ultimately, investing in Shop as Hon Hai with advanced technology and production capabilities. Here is the partnership between Shop and Hon Hai, highlighting their mutual needs and offerings. From Shop's side, it was facing financial challenges and wanted to boost its productions and reduce cost efficiency. Plus, Shop needed international market presence and access to high-value supply chains. Hon Hai could provide Shop with funds, expand its business size, utilize resources for cost reducing, and connect a global market with world-class supply chain for Shop. Turning to Hon Hai's side, it aimed to break through its technology and optimize production capabilities to expand the market size by Shop's capability. Lastly, were mutual benefits from branding and supply chain. Therefore, Shop and Hon Hai win-win partnership can be highlighted from those 6 aspects. Financially, Hon Hai ROA and the net profit margin has relatively stable performance. Its FCFE and FCFF per share suggests a substantial free cash flow available for strategic investment. The increasing total operating revenue growth rate and the current ratio indicating a healthy short-term financial position also gives Hon Hai confidence to invest. Let's move to partnering.
Okay. At this point, we will show you the transactions happened between Stripe and Hon Hai and why Hon Hai put up the investment. And first, we look at the Terry Guo's investment in SDP. And Terry Guo has completed his investment in August 2012, but just 37.6% of SDP. That is different from which is announced of 46.5% of SDP share. This is mainly because SDP executed business integration agreement with Top-End and DNL respectively, and transferred LCD color filter businesses and the Sakai plant. to SDP in the manner of a simplified absorption type company built. Based on the module assumptions, we got a positive NPV of more than $250 million US. Then we say Terry Gou made the right decision to invest in SDP. But also, it is a good deal for Hon Hai to invest in Sharp. The investor in Hon Hai can enjoy the trade positive response brought by improvement in SDP performance without having to bear the cost of investment. From the financial perspective, the future expectation for both PB and PE presents a continuously increasing tendency. Therefore, it is profitable. However, the things didn't go well as expected. Sharp's annual report released in April 2012 and the first quarter report for financial year 2013 shows its dismal financial performance. The decline in stock price coupled with poor financial performance has led to a stagnation in trading. Inevitably, Hon Hai announced the second day after the release of its first quarter report that due to the rapid decline in Sharp stock, they did not need to fulfill the agreements to invest at the agreed price. And the price of 550 yen per share was originally about 11% premium of the stock price, but was 2 times of the close price of August. So when the investment was started in 2016, Hon Hai and Japan Investment Corporation have both initiated the acquisition of Sharp, and Hon Hai successfully acquired 66% of Sharp equity for 88 yen per share. So for Hon Hai, it's the price is lower than the markets, and they obtain operational right and absolute control. From Sharp's perspective, the company grappled with persistent financial difficulties between 2013 and 2016 with no relief in sight. This financial setback underscored an urgent need for strategy, restructuring, and more rigorous management initiatives. And that's what we move on to Louis after the investment.
So after investment, the Sharp's financial deficit was mainly due to its large investment in SDP. However, Sharp's lack of good marketing capabilities has led to a continuous decline in its market share, resulting in insufficient orders, then enter into a vicious cycle of substantial losses. Hon Hai could help Sharp enter a profitable positive cycle at multiple points in the growth cycle. As part of Apple's supply chain and world leaders in precision manufacturing, Hon Hai has excellent market expansion capabilities, helping Sharp regain market share. At the same time, Hon Hai itself would also undertake a portion of Sharp's orders and provide financial assistance to Sharp. In this way, Sharp could break free from the cycle of continuous losses. Next. Following Hon Hai's acquisition of Sharp, there was little improvement in Sharp's financial status. Throughout this period, Sharp was best by escalating market competition and slowing transformation and strategic adjustment in the face of global LCD panel industry downturn, resulting in a continuous erosion of its market share. According to Hon Hai CFO Alex Huang, stated that Hon Hai holds 34% of Sharp and has recognized an extraordinary loss of 17.3 billion Taiwan dollars based on the ratio. Between 2016 and 2022, Hon Hai has cumulatively recognized an investment benefit of 40 billion Taiwan dollars. However, in 2022, Sharp incurred a substantial loss exceeding 260 billion yen and was largely attributed to one-time charges, including an impairment loss in display segment. Such a substantial loss directly affected Hon Hai's return on investment, casting doubt on value and potential returns of investment in Sharp. Next. In 2023 and 24, Sharp experienced negative ROE, significantly lagging behind both its competitors and the industry average. Concerning with the PE ratio, despite it fluctuated over time and staying within one standard deviation of the mean, they were consistently lower than those of its rivals. So overall, we predict Sharp's financial decline will continue. This is the end of our presentation. Thank you for watching.